Economic indicators are tools for tracking the changes in the economy. And those changes develop in cycles, whether monthly, quarterly, or annually. By tracking these cycles, we can spot trends in growth and inflation to determine where we are in the macro season and if any changes are underway. The two primary ways of using economic indicators are by forecasting the future using leading and lagging indicators, or by using economic categories to diagnose a specific sector or industry. By using leading and lagging indicators, we get a sense of the overall direction of the economy. We're basically forecasting the future trend of growth, and these forecasts create baselines and expectations for markets to anticipate. On the other hand, we can use economic indicators to analyze specific categories. And this gives us the ability to diagnose specific sectors or industries that might impact the performance of certain companies within that sector or industry. Think of a giant ship powering its way through the ocean to meet its destination. Leading and lagging indicators are much like a compass, which helps the captain to guide the ship's direction. Economic categories separate the ship by specific components to further understand how each part is performing. Is the engine running correctly? What about the rudder? How about the anchor? Is the crew healthy? This helps us to understand how stable the ship is, the stability of the economy. Where are the weaknesses? Where are the strengths? So first, we're going to start with the leading and lagging indicators for growth and inflation. The two major indicators for growth are the GDP growth rate and the unemployment rate. GDP measures the total value of all goods and services produced during a given period of time. The average GDP growth rate is around 2 to 2.5%. Anything below that causes a little bit of worry, and anything above that is considered strong. The unemployment rate measures the percentage of labor force that is unemployed, but still actively looking for work. And a high, increasing unemployment rate indicates a large portion of the population just can't find work, which is a systemic issue to the economy. According to the National Bureau of Economic Research, the natural rate of unemployment is between 3.5% to 4.5%. When it comes to inflation, we measure it by the inflation rate, which is the Consumer Price Index, CPI for short. CPI measures the changes in prices of a basket of goods and services which are purchased by the average consumer. The average inflation rate is between 2 and 3%. Anything within that range is normal. Anything exceeding this range is cause for worry. So let's keep in mind these are the normal ranges for GDP growth, the unemployment rate, and the inflation rate. And when economic indicators move out of these ranges, that's when we want to pay attention. Although these major economic indicators are crucial for understanding growth and inflation, they are lagging indicators. And this just means they don't predict future trends. Rather, they confirm what's already happened. They reflect the economy's actual performance over a past period. But if markets are forward-looking, why would they be concerned with this lagging information? See, the value of these lagging indicators is that they provide economists and investors with a baseline for making future forecasts. They also allow us to see the real impact of fiscal or monetary policies, confirming how these policies are shaping the economy. Therefore, markets care about how policymakers might react to this data, which causes these investors to adjust their strategy. For example, if an investor anticipates that inflation will come in hotter than expected, they might add inflation hedges to their portfolio or move into cash as a safe haven. When the actual inflation rate is released, if it comes in lower than expected, the investor might need to rethink their strategy, adjusting their portfolio or revising their forecast. Another investor who is bullish on the economy might expect GDP to confirm growth. When GDP reflects that the economy is indeed expanding, it reinforces their confidence to remain bullish. It can also influence them to increase their exposure to higher growth assets. In a world where market participants are always forecasting the future, lagging indicators serve as a confirmation. They provide hard evidence for policymakers to adjust policy and establish a baseline for investors to predict the future trend of the economy.